Welcome, everyone. Happy Wednesday. It's not normally a happy Wednesday, but today we get to talk about Enron. So I dressed for the part just for you guys. I decided to, got my Enron Risk Management Department shirt. So, only time I will crack this out, but it's appropriate because we're going to be talking about misstatements and auditing today. I don't know if it's relevant to AIS, but that's okay. They can deal with it. So yeah, Enron, you know about the myth legend. How much have you studied about Enron before you actually talked about it in this course? I mean, I know you've heard of it, heard the terms about it surrounding it. How much in-depth detail have you gone into it in other courses? Not a lot. So this will kind of be an exposure to what Enron is all about. Interestingly, Enron, they've actually got a website, a current website. This is not a archive website from 2002. They're trying to make a comeback, and you can kind of see they're talking about revolutionary energy. I don't know that using that name that you will actually experience any sort of customer confidence. It just seems kind of an awkward scenario.
Satire.
Yeah. Oh, satire?
Yeah, it's from the guys who made Birds Aren't Real.
No kidding. Okay. Interesting. Well, that's I randomly. I know Anderson came back, so I thought it wasn't outside of the realm of possibility of Anderson. So that's amazing. Okay. All right. Well, this will be worth exploring even more now to find out about it. Yeah, I kind of browsed around that. I was going to have something in the background while we're talking about Enron. And I thought, what better did the Enron's relaunch? But apparently the relaunch is a joke. And there you go. Which is a whole bunch of stuff about it. So before we get started, I did have one person, despite the fact that tax track Kyle seemed to evade my lectures, no matter what is here, but he did request that I make an announcement. If you are willing to serve as a greeter for VITA days, please reach out to him, let him know. They're still short a few greeters, and he reserves those for audit track, which is often nice. So it means you don't have to get your hands dirty on tax returns, but please let him know. Again, that's the quote unquote extra credit opportunity for this course, which is basically getting a free 15 out of 15 on the quiz. So yeah, we're going to talk a little bit about that. We're going to talk about that more, but please make sure you reach out to Kyle. It's a very, very simple, straightforward opportunity. And whether you like it or not, you are going to have to do tax. Okay. And I know that doesn't sound good. That's why you try to come this direction so you can avoid it. But yeah, that's something you have to encounter. And so might as well get at least some expertise in it, whether that be prepping for the CPA exam or just prepping for actual life. Always one of the miserable times of the year whenever I get all my tax documents together and say, yeah, despite my best efforts, I guess I could hire an accountant. That would kind of be the purpose now with it. All right. So I think to start out, I've got a couple of those. I'm going to pause the recording because I wanted to show you something that I found. I've talked about this in every one of my class periods up until this semester, and I actually found it because I got a subscription to Peacock about middle last year, and I found out Saturday Night Live has archived episodes on Peacock. Okay, so I'm going to go ahead and so you notice here that this is the episode of Jack Black from January 19th, 2002, and not a good picture, but you recognize this gentleman right there. That's Jimmy Fallon. Look at that hair. That's amazing, isn't it? Yes, Jimmy Fallon. But I'm going to pause and then we're going to watch this. And it's not Jimmy Fallon's joke, but I figured I'd just go ahead and let you guys see what Jimmy Fallon's like. Everybody know he used to host Weekend Update on Saturday Night Live? Yeah, okay, crazy stuff. Anyway, yeah, so this is the first time I've been able to show that. I've talked about it to my students in this mythical Weekend Update segment that talked about how Tina Fey went into Enron and the whole debacle. The most amazing thing about that whole clip is all of the dated references that nobody of this generation is going to get. Like this guy right here is absolutely famous 23 years ago about this series of commercials said, dude, you're getting Adele. You can actually find YouTube clips on it. But yeah, the joke itself is just kind of like, yeah, that's hilarious, Dr. Barnes. Yeah. But some of them were pretty big hits. But I've been looking for that clip for a long time. We finally got it. I feel vindicated that we're actually. By the way, if anybody wants to watch that entire episode, it's Jack Black, January 19th, 2002. Okay. Yeah. So, I'm guessing, so 2002, that's about right when most of you all were born, right around that time period. Yeah. Okay. Yeah. What's that? A year too early? Yeah. Okay. Wow. So yeah, that kind of dates me is that I remember watching that, remember watching those Saturday Night Live episodes right around that time period. It doesn't seem like it was that long ago, you know, because Tina Fey and Jimmy Fallon still hang around, 3 years ago. Yeah. All right, so let's go ahead and talk very quickly about the nature of Enron case. So there's some things in the case that we answered questions about, but I want to talk very quickly about the nature of some of the things that were in the case. So first of all, obviously this is an auditing case. We're going to talk about the auditor. There's a little bit of background of Anderson and how it got started. Now, how would you guys describe Arthur Anderson, the person? The corrupt, physical, bad guy, kind of like the described with nature of it. No, exact opposite. Okay, very, very straightforward. What the way they described him is they actually that forward phrase: "Think straight, talk straight." All right, and he was kind of characterized as a grouch, but he was very honest. That was his basically his characteristic. That he would tell you straight to your face if something was wrong, but there's no words about it. And so he really kind of took off in the 1930s. Now, there were a couple of little anecdotes that were told about what the nature of Anderson was. One of them was in 1915 when his first started, and a steamboat operator who was trying to determine whether or not a sunk steamboat should be reported on the financial statements. They said, yes, this is information that your stakeholders would want to know about, even though it doesn't relate to the period under audit. So that actually reflects on something that we do nowadays in auditing. We don't talk about subsequent events and the nature of reporting. There were no guidelines that required subsequent event reporting at the time, but this was one of those ones that he said, this is really important. And it kind of set the foundation for how we treat subsequent events. There was another one a little bit later, 20 years later, back, I think it was 1935, very large chemical company that was arguing about their definition of operating income. Does anybody remember the name of that company? The chemical company? Still a famous one now. DuPont. DuPont is the name of the company. And Anderson was brought in to mediate the argument between the partners and the managers. And he said, yeah, I agree with my managers. You have to use the conservative interpretation. And DuPont said, you're fired. It's okay. He said, yeah, all right. Best of luck to you. So it was very interesting in the fact that Anderson was so brutally honest, and that was what he was his representation, and that's how he built his firm. That integrity and that honesty, which again, given the joke that Anderson is kind of the punchline that Anderson kind of puts up now, is kind of contrary to what we believe. Now, what did we say about the Great Depression? Was the Great Depression a good time or a bad time for Anderson? It's actually a good time for Anderson because a lot of banks were trying to try to determine if people who were applying for loans were worthy of those loans. There was a big demand for audits, and so they knew Anderson's integrity and his reputation and said, we're going to actually provide that. And he managed to grow his firm pretty substantially during that time period. So some interesting things about Anderson, the legacy of Anderson. First of all, one thing that you guys will learn to love and hate, or grow to hate, I guess what the term is, continuing professional education, which I will honestly say that it's important to have that. You can't just learn accounting at one point in time and say, I know everything I need to know now. You do have to understand the changes in accounting, and he was a big advocate for that. But you all, when you get your CPA license and then have to suffer through 40 hours of CPE and trying to make sure during termination that you got it all, be kind of like, oh, Anderson, for different reasons. And then also consistent accounting practices. So back before the 1950s, there was not a consistent use of accounting practices between firms. I'm not even talking about industries, between firms. Firms could basically set their own rules. There was some consistency, but for the most part, comparability between firms did not exist. And so Anderson was like saying, we've got to make consistent accounting rules. Every firm has to follow the same rules. And so he started up this group, or he was kind of the spearhead for this group called the Accounting Principles Board, the APB, which the Accounting Principles Board, but they go by a different name. They were actually morphed into a different group called the Financial Accounting Standards Board. So that's what they eventually became. All right, what about Enron? Enron started in kind of 1930 as Northern National Gas. Northern Natural Gas. And it's very interesting because they were not doing very well for a very long time because they were trying to sell natural gas, and everybody's like saying, you know what? natural gas is really just too unsafe because everybody had this belief that natural gas behaved the way it does in the movies. Has anybody ever seen that movie Shooter with Mark Wahlberg? I won't spoil it. At the very end of the movie, he basically hits a natural gas line with his rifle and then leaves a open flame out. And he's walking away, and the entire house explodes behind him. And he's just like got his sunglasses on, just walking away. But that's how people believe natural gas explains that, or actually, natural gas explodes. It's not the way it works. Mythbusters prove that, but it's still pretty dangerous. It can ignite, and a lot of people were really worried about that. And so this changed again right around the Great Depression. They were actually beneficiaries of the Great Depression as well, because the cost of coal and the cost of natural gas were starkly different, and people were saying we need actually lower cost fuel to be able to conduct our operations and heat our homes. And so they actually grew as a result of that. So in 1980, they were rebranded as Internorth Incorporated, and then they became Enron, which is when Kenneth Lay and Jeff Skilling came in 1986. And so Skilling's plan was to change Enron from a natural gas supplier to an energy trading company. So I will say, aside from all the corrupt acts that Skilling had and kind of the character that Skilling was, he actually was pretty visionary in the fact that he thought this was going to be the future for energy. And this is something we actually see now in this day and age in any commodities exchange, is that you can't really be a commodities provider, you have to be a commodities trader. And so he wanted to focus Enron more on marketing and logistics. And he actually said Enron's biggest assets are its well-established business practices and its innovative people. And you heard the term, it was actually used as the title of one of the sections of the case. It said the world's greatest company. That was his goal. He wanted to make Enron the world's greatest company. So now that was kind of an ambitious goal. And I think honestly, if Skilling and his compatriots at Enron had actually been a little bit honest, just even a little bit honest, they might have been able to accomplish that. As it was, they were willing to basically cut corners to be able to accomplish whatever they wanted to accomplish. So one of the stories they talked about was the California energy crisis. Now, Enron was kind of accused of profiteering as a result of that. And it's very interesting because they don't really, DAP doesn't really go into the detail of the case, but this is something you can find online. It's actually a section of the movie, the documentary, Smartest Guys in the Room. And then there's also some websites that actually have stories about this. But the California energy crisis, basically what happened is that Enron made the argument that its resources, its energy that it was providing was in high demand. That was the requirement that they had to increase the supply. Now, keep in mind, this was during a period of deregulation. The Republicans just taken office, or were about to take office, I should say. So this is 2001, going into 2002. Republicans are about to go into office. Actually, I guess it was early 2001. So they take office in 2001. That was, by the way, that was the big, that was Clinton was in, I had just finished his second term, and that was the George W. Bush, Al Gore election, where there was a lot of concern about whether or not Gore won. Gore won the popular vote, but George W. Bush won the electoral vote. And so there's a lot of rigmarole surrounding who actually won. And eventually they admitted that Bush won the electoral vote, so he was going to take over. And one of Bush and Cheney's big actions was to try to put pressure California to deregulating energy, which was not a good idea, because then Enron stepped in and says, well, we can do whatever we want. And they did. So during peak volumes, when people were demanding energy, they basically fabricated reasons to shut down their system, shut down their generators, and that were providing energy. So they were actually creating artificial blackouts. And if these blackouts came up, they said, well, we're going to need more resources if we're going to be able to provide all this energy. You can see there's big demands for this. So they were trying to justify increasing their prices in blackouts. And it was very interesting because a lot of people were very critical of it. And they talked about in the book, Skilling's Titanic joke says, what's the difference between California and the Titanic? It's at least when the Titanic went down, the lights were on. Skilling was kind of a jerk. Yeah, he was kind of a jerk. And so, yeah. So then moving forward, kind of what started the whole ball rolling downhill was basically a restatement for stock for the stock notes receivable swap. So basically, the nature of the transaction, as Enron recorded it, was they were exchanging stock for a notes receivable. And so the item the item they recorded as they're recording an addition to assets, which is the notes receivable, and issuance of stock. Now, they were looking, Anderson was looking at the substance of this transaction, and they were saying, look, the people who own these receivables or who own the receiving stock are insiders to the organization. So this is not really a transaction that is going to benefit an asset because these are people who are associated with the organization. It is more appropriate to say that since these are stakeholders of the organization, that this swap should actually be treated as a reduction of operating equity or a reduction of owner's equity rather than an asset. It should not be recorded as a receivable, it should be recorded as a reduction of owner's equity. Now, think about that. Does that make sense? Do those move in the same direction? So if I reduce owner's equity, that would be a debit, and an increase in assets would also be a debit. So it doesn't really throw the balance off, but is the nature of that transaction somewhat different? Would stakeholders interpret the nature of the transaction differently? Absolutely, absolutely. So if you're a stakeholder and you look at Enron and you say, we just increased our assets by 1.2 billion, you're probably like, oh, great. Okay, that's fantastic. That's awesome. And then otherwise say, no, wait, we didn't increase our assets by 1.2 billion. We reduced our equity by 1.2 billion. That has a much different ring to it, even though the debit is exactly, the debit amount would be exactly the same. The fact that it goes to a completely different account, it reduces your ownership interest, which probably does not make you very happy in the long run. And so everybody kind of started questioning things and speculating, and that set off an avalanche because the stock price started dropping immediately after that. And so the resulting restatements, that they basically, as a result after that, they started restating some other items because they were really concerned about the transparency. Eliminated $600 million in profits, stock tanked, and basically the further events led to declare bankruptcy, which was $60 billion of losses on stockholders. Okay. Now, it's very interesting because at the time, this was the largest bankruptcy in U.S. history, I think the world history, actually. WorldCom came on along a weird a year later and said, hold my beer. Said did $100 million. And then we had Lehman Brothers 2008. You guys are amateurs and decided to do it for a tune of 600 billion. So I think we may look at Lehman Brothers a little bit later this semester. I think I have it on the schedule, but some interesting stuff along with that. Now, one actually interesting we'll talk about is I want to talk about special purpose entities, special purpose vehicles, because this is an accounting treatment that is so convoluted that nobody understands it, not even people who've been accountants. What I'm going to teach you is not going to be the depth of this, but I do want to talk about the intuition behind the special purpose entities and special purpose vehicles about why they were used in the way they were. So this was something that was widely acknowledged as something used, and financial magazines actually applauded Enron, saying, yeah, using special purpose entities to move debt off the balance sheet, that's a great idea. Now, the idea being is that the stakeholders should have knowledge that this is happening, but because these are not consolidated items, they don't get reported. And so nobody had any idea of exactly how much debt Enron had off the balance sheet. And so they really kind of defeated the purpose. Now, what was going on here? What was basically happening? How was Enron abusing these special purpose vehicles? And it had a lot to do with the nature of mark-to-market accounting that was occurring at the time. So mark-to-market accounting is a legitimate business approach, and it's something we still do today. But the way that it was actually documented and the way that it operated back then is that if there was an investment and they would speculate what their profit from the investment would be over the life of the investment, they would book that profit in a quarter of the investment. All right. So I think there was one example where they had an investment in an Indian startup where they were going to build a facility, and they were projecting it was going to be 20 years of revenue after the building of the facility. They were trying to project what the profit was going to be, and they booked that the first year. And the interesting thing about that booking is that Indian facility was never built. It was never even started because Enron went out of business, but they booked that profit right immediately upon finishing the contract. So what happens in that situation? How does that actually lead to abuse? So let's just go ahead and look at a simple example. Now, like I said, this is not perfect, okay? But it is going to be a very simplistic visual illustration. And even the simplistic version is a little bit hard to wrap your head around. So we have Enron with their initial investment, we'll say $100 million, all right? They issue an investment for $100 million and they finance it through a bonds payable of $100 million, which is pretty straightforward. This is pretty natural accounting. I think that you've seen stuff like this in financial accounting. So everybody with me on the first one so far, okay? All right. The investment starts to tank. It's no longer worth $100 million. So naturally speaking, Enron should have to write that down, write down the investment value, or just basically recognize that it's going to have a unrealized loss at some point. But instead, they start to take advantage of the special purpose entity and say, we can actually work our way out of this through a special purpose entity. The idea being is as long as there's 3% outside investment in special purpose entity, they can they don't have to consolidate this in financial statements. Now the 3% is a little bit fuzzy. Okay, we'll talk about why in just a bit. But basically, they have a special purpose entity purchase the investment. Okay, so they buy the investment for a gain of 100 million because they buy it for $200 million, and they actually pay cash for $200 million. So Enron gets an inflow of cash, which is their own cash, effectively, but they also get to recognize a gain of $100 million. Now, if this was a consolidated entry, this would not matter. Okay, this would not matter because basically it would wash out once the consolidation entries took place. But because of the gain, because of the fact that Enron actually recognizes the cash and recognizes the gain on sale investment on a special purpose entity that does not get consolidated, they get to hold this on their books, which makes them look like they're superstars, even though this is an investment that is losing value, Now, there's a couple of interesting features to note about this. So basically what happens is they book this entry, Enron effectively recognizes this entry on the sale, which is just manipulation at the highest level, okay? Now, it's part of me when I look at something like this, I'm just kind of like, wow, this is just devious. This is so incredibly awful that some people do like that. Now, part of me is just kind of like, wow, that's impressive, bravo, So yeah, that's why I probably should not be part of the risk management department. So anyway, there are a couple things to note about this. Now, first of all, obviously the 3% threshold was a bit of an issue. I think there were some disclaimers made about, is 3% sufficient? The answer is absolutely no. All right, 3% is not sufficient. These were a very special purpose item that were created in the 1990s, specifically for the purpose of very specialized entries or very specialized transactions. And this was abusive to the nature of what special purpose entities are supposed to do. As you heard, they talked about subsidiaries. I think Tina Fey said something like 690 something in the Cayman Islands. That's obviously ridiculous. And they were doing this just for the nature of these transactions. One problem with the 3% threshold is that it's supposed to be outside funding. Somebody who's not associated with Enron, as long as they got outside funding, it would be associated with it. A lot of these special purpose entities, in retrospect, when they looked at it, were actually funded by executives of Enron. Andrew Fastow actually held $30 million in interest in special purpose entities, and he recognized ridiculous amounts of gains in that regard. Or maybe that was some amount, but he recognized $30 million in gains. Also, you will notice here highlighted, it says cash was initially obtained by loans collateralized by Enron stock, okay? So this cash basically was created through loans and created a loans payable. Whenever you have a very large debt instrument like this, this is going to naturally lead to some covenants that are going to be set in place, some loan covenants. One of the arguments in the loan covenants is that a certain amount of stock had to be held to cover the amount of the loan. So Enron actually had to have stock set aside that if the loan ever defaulted, that they could actually recover it through the value of stock. Now think about the intuition behind that, all right? The stock itself is going to be represented by the market value, but if you start issuing a lot of loans that people start realizing or capitalizing, what's going to naturally happen to the value of Enron stock over time? If you start issuing stock, if you start issuing stock to cover the loans, you increase the pool of stock. The value of the stock is going to go down because you're dividing by a larger number. When you divide by a larger number, the result gets smaller. So Enron stock's worth $100. Then you issue more Enron stock. It goes down to $90. The collateralized loans is no longer, collateral on the loans is no longer sufficient to cover. So they have to issue more stock in order to cover that. You divide by a larger number. Enron stock naturally goes down. You have to issue more stock. You see the circular pattern of it? This is the nature of perpetuation of fraud, is that usually some sort of feature of fraud is going to lead to that perpetuation. And this was that perpetuation cycle here, or at least one of the perpetuation cycles. All right, so yeah, we've kind of gone into the detail on that. And so one of the things to note here is that Joe Berardino was kind of talking about the nature of Anderson Services and what they provided to Enron. There was a lot of criticism surrounding the independence of Anderson. And we're going to talk a little bit about that when we get to the questions. But one of the things that was noted was that $52 million in total of fees were paid to Anderson for the year of 2001. $52 million, $1 million a week. And only a little bit less than half of that was for audit services. Now, we don't experience that in today's day and age because we specifically have PCOB regulations that say you cannot provide other types of services if you're the auditor. But do we understand why that might be a problem in that scenario if they have non-audit services that are greater than the audit services? Yeah, because if they're getting paid a lot of money and they say, well, we really want you to pay close attention to this audit, we think that you may have a material misstatement. Enron may say, do we have a material misstatement? Think carefully. You may lose $52 million based on your answer. Okay, and that's a real concern there. If it's just the audit fee, it may not be as much of a violation or an issue. But if it's going to be other fees that are going to be contingent on a baseline answer, it's going to be an issue. It was very interesting. It said 1999, I guess it was 1999 that feature was talked about. In 1999, and I think this figure was in the book. If not, I found it somewhere, that for every $1 of audit services, public accounting firms were reaping $2.69 of non-audit services. So basically, the dollar of audit that you were being paid for your objective audit is kind of being scaled over by additional $2.70 of additional services. So if you lose an audit client, you don't just lose that dollar of audit service. Each dollar of audit services, you lose $3.70 to that dollar of audit services. It's kind of crazy that scale, that scope, and that's kind of why we had such a substantial change. That leads to some questions. Okay, so some questions I have for you guys. All right. So starting off, the Enron debacle created what one public official reported was a crisis of confidence on the part of the public and accounting profession. List the parties you believe are most responsible in that crisis and briefly justify your choices. All right, so we don't need to go too much in justification, but I'm curious what parties you had. Colin, you're going to kick us off. What parties do you think you junior group identify in this particular scenario?
Anderson and Company.
Okay. Just Anderson?
Oh, like all.
Yeah, all of them.
Oh, okay.
Everything.
Yeah. Enron's management executives, Jeffrey Skilling, former CEO, Enron, Ken Lay, the original CEO. Then we had SEC and SPE.
The special purpose entities themselves. That's
Yeah.
fair. That's fair. Yeah, special purpose entities. They're kind of fictionalized vehicles of Enron, but we can set some blame on those for sure. I will say that's a good insight identifying the SEC. I don't think that regulators were taking nearly as much insight into situations like this. We can actually identify probably a lot of governmental agencies or governmental entities that were to blame here. Particularly, we talk about the nature of regulation and what there was going on there. Can we blame other accounting firms as well, other than Anderson? So what do we know about the nature of auditing prior to 2002? Was the PCOB in place at that time? So who was reviewing the work of Anderson? Other accounting firms. It was other accounting firms reviewing the work of Anderson. So presumably whoever was doing that work should have noted, like, you guys are really not doing a good job. You guys are really kind of punting here. This is really silly. They've been reviewing the work, but it was kind of a well-known feature at the time that when another accounting firm came in and did the review, that they softballed it. And that was kind of I scratch your back, you scratch mine, because if they gave them really difficult questions and made their life difficult, then that firm may come in and do the same thing to them later on. So that's an interesting feature as well. But yeah, in general, I think that was pretty good identification of who was responsible for the crisis. Who do you think is the most responsible for the crisis? Who did your group identify for the most responsible? If we were to identify one party, what would your group say, Colin?
Probably say Enron or Anderson.
Yeah, the Enron executives, I think, probably were the ones we can point the fingers at the most. When you have a culture of a situation where we got somebody like Jeff Skilling who's willing to belittle other people for bringing up issues, and then Ken Lay subsequently saying, "Hey, we got a problem. I don't want to hear about it. That's too much for me to worry about." Yeah, that's kind of the Enron management team. I think is the best one. Probably followed by Anderson. Anderson should have been a little bit more industrious in their regard. And so, listen to the three types of consulting services that audit firms are now providing clients to public companies. And then discuss how they could affect auditors' independence. So who's up next? Matt, what's your group identify here?
All right, so we got financial information systems design and implementation. Can't do that. Internal audit functions. If you're going to be an external auditor, you can't just be an internal and strategic consulting services. The main reasons for all of these just boil down to it impedes your independence.
Yeah. Yeah, so let's think about the very, very most transparent of those. And all three of them fall in the same category, but I think the AIS is a pretty easy one, all right? If you come in, you set up the AIS and basically create the flow of transactions and create the flow of the system and dictate how transactional flow of the system, what controls are in place, how the entire information system works. Then you come in and you work as an auditor. Whose work are you auditing? Your own, okay? How many of you all think you could be completely and totally objective if I asked you to grade your own work? Okay, I believe Matt. Okay, Matt's basically a robot, so yeah. So I believe that could be the case. And I'm sorry, Matt, it was just there. No, but I don't think any of us think we can be completely and totally objective in that scenario. Most of us don't think that, and that's why I don't have students grade their own assignments or grade their own quizzes, because I don't believe that objectivity exists. And the same thing holds true if we talk about auditor evaluating their work. They're going to say, I know my work is solid. I'm the one who did it. Okay. Which is good to have confidence in yourself, but it's really hard to be completely and totally independent in that regard. All right. For purposes of this question, this is number 3. Assume the experts of the powers reports shown in Exhibit 3 provide accurate description of Anderson's involvement in Enron's accounting and financial reporting decisions. Given this assumption, do you believe that Anderson's involvement in those decisions violated any professional auditing standards? If so, list those standards and briefly explain your rationale. All right, Leah, what's your group come up with on this one?
Yeah, I mean, I feel like it's kind of obvious to say they directly violated the standards that are now in place based on just how they had direct like participation in Enron's SB structuring. As soon as they saw once things started to go sour, it said that Enron tried to help them kind of place their SBs differently, which is just that's fishy in itself. So
yeah, I meant to do a better job of bringing this up. I was going to say, because we didn't have PCOB standards in place at the time, okay? But if we can look at general responsibilities audit, these are kind of generated from what the ASB had in place at the time of Enron. And so let's just go ahead and look at some of the professional qualification of the auditors and see if any of these were violated in the case of Anderson. So independence and ethics. Do we think that Anderson had a violation of independence and ethics in their administration of the Enron audit? I think this is a pretty easy yes. Okay, independence is definitely an issue. They were not independent of either fact nor appearance. So that's concerned. Competence. What do you guys think? You might make an argument for it, but otherwise, I think that Anderson was generally competent. I think they were fine on that regard. They knew what needed to be done. They just didn't do it. Okay. Due professional care, including professional skepticism. What do you guys think about that? There was a severe lack of professional skepticism. Certainly no due professional care associated with that. What about professional judgment? I think they could have exercised better professional judgment in this particular scenario. This is probably an extension of previous points, but for the most part, I think we can say that professional judgment was not. Now, again, this is operating on PCOB standards, but these are effectively the same criteria that were in place at the time. Due professional care still existed. Professional skepticism was still a concern. So, yeah, I think it's very easy to make the argument that Anderson should have done a better job of their applicability of these basic professional standards. All right. Really describe the key requirements included in professional auditing standards, including the preparation or retention of audit work papers. Which party owns audit work papers, the client or the audit firm? Maddie, what'd your group say on this one?
However, they have to maintain confidentiality. Can't disclose information without fines.
Okay. So the current standards, now we talk about PCOB standards. PCOB standards say that they have to retain for a period of 7 years, unless a longer period of time is required by law. They have to archive within a 45-day window. So that's something that this kind of requirements that we've talked about to date. But one of the things that was brought to light in the case, and this is something that's this is very, very divisive, this particular issue, is the shredding of work papers, right? Now, when you all look at that, you kind of say, well, this is not going to be relevant to me. First of all, you probably say it's not relevant to me. We're doing electronic work papers. But think about it, the electronic equivalent. If you start deleting files from your electronic storage, would that kind of be the same thing? Now, let me play devil's advocate real quick, because this is an argument that I got into with a friend of mine. Because I had a friend who was basically making fun of accounting and auditing, and this is back in 2002, and he was talking about Anderson was obviously guilty because they were shredding work papers. Might there be a reason that you would justifiably shred work papers? Certainly, if we're talking about client supporting document that actually go into the work papers, like keep in mind that if you're going to if you're going to test, excuse me, if you're going to test like accounts receivable, if you're going to test inventory, you need client supporting document for that. Should we hold on to the client supporting documentation for a long period of time? If it's original documentation, the client probably wants that back. What if it's copies of the documentation? Do you think the client wants us to keep that? Probably not. They're probably going to say, you need to shred these things. That's proprietary information for our organization. So yes, there could be an argument that shredding work papers would be justified, okay, or at least items associated with work papers. What about the documentation itself, though? What do we know about the nature of documentation? Nature of documentation is supposed to contain everything that was involved in the opinion rendered by the auditor, and this includes anything that does not support the opinion. So if you have evidence that is inconsistent with the opinion, it still has to be included in the work papers. What do you think Anderson was likely shredding when they went through the shredding process? Probably that information that was inconsistent with the opinion rendered, all right? We don't know because, well, it was shredded, but that was what it was saying. If we're assuming that that was the case, then we probably can say this was a violation of the documentation and retention standards. That being said, I don't think you can just immediately say they were shredding, they're obviously guilty, okay? You see a shredder, not automatically a sign of guilt. I have a shredder for a lot of documents in my house, and mostly that's just because I don't want anybody peeling through my garbage and taking out credit card forms and thieving my debt, okay? So those of you who have been hanging around my house looking through my garbage, stop, okay? You're never gonna find anything, that's all I'm gonna tell you. All right, identify 5 recommendations made to strengthen the independent audit function for the Enron scandal, and then indicate whether you support the given measure. So let's just go ahead and go around the room and we'll do one for each group and talk with each a little about them. So Colin, what's one that your group identified?
Revise the rules about non-audit services that could affect an accounting firm's independence when provided to an audit client.
Okay, did your group support that?
He said, we support it. Independence is key in performing an audit.
Okay, good. All right. Matt, what's your group say?
It created the PCAOB and meant that the accounting professionals could no longer sell them.
Okay, so would your group support the creation of PCAOB and the renewal of that regulation?
Yeah.
That's a little bit more subjective, but I think ultimately the PCAOB has been proven strong. So overall, I would agree with that. But it's a little bit more subjective. Leo, what's your group identify?
Issues that required public companies to do it.
Okay. Yes, internal controls, rah, rah, rah. Section 404, woo! What'd your group say about that one?
I obviously support it.
I was a little bit worried that maybe I motivated you to say you supported it and you said, well, we didn't support that, Dr. Barnes. We think controls are overblown, which that's your justification. That's your perspective if you believe that. But if you don't believe that, thank you. That'd be great. All right. Maddie, what'd your group identify?
One about like whistleblower protection and like protecting the individuals that provide that useful information.
Okay, and so probably don't need to ask this, but did your group support that? Okay, that would be weird if you said, no, we don't support that. Yeah, whistleblowers should be held liable. Yeah, that would be weird. Yeah, I definitely think that was one that it's actually changed kind of the landscape of reporting. And that was one big reason why we had such a big avalanche of fraud disclosure that occurred right around that time period, is because those whistleblower protections were on the landscape. They weren't actually implemented at the time, but we were starting to see that there's going to be a lot more support for whistleblowers like Sharon Watkins and like. All right. Do you believe there's been a significant shift or evolution in the past several decades in the concept of professionalism as it relates to public county discipline? Colin, what'd your group say on this one?
He said professionalism in accounting is used primarily to evolve manual processes and record. And record keeping on paper, accounts are expected to apply their knowledge and principles and be able to complete work manually. Now with advanced technology, most of the work is done with technology or AI, so accounts are expected to be able to leverage the technology and use that to their advantage.
So you're basically saying that because of technology changes, the concept of professionalism has had changed to adapt and encompass that adaptation to technology. Okay, that's insightful. That's honestly not the perspective I was angling for, but I do think that's actually a very, very important point to make. Are there areas other than technological changes that we can actually apply the changes in professionalism? I think that's a really good one, and I don't want to diminish that, but has professionalism changed for other reasons? Like social and cultural changes that might actually approach the changes in professionalism? I definitely think that if we think about the social changes, we definitely view corruption and fraud much differently now than we did 20 years ago. So professionalism is going to be a lot more focused on making sure people are held accountable for their actions. Interestingly, I don't know how applicable this is, but have we seen cultural shifts over the past 20 years? I mean, we started to see, basically a lot more push towards gender equity, okay, or even diversity, equity, inclusion, all those issues. Could that be encompassed in our shifts in professionalism? I do think that that's something that's important to consider and something we probably don't spend enough time on. It leads to a very interesting conclusion. And I apologize for this, but I do think it's an important question to ask. But think about Sharon Watkins and her memo to Kenneth Lay. If it had been a male executive, do you think he might have taken that a little bit more seriously? Certainly possible. That was the landscape that existed in 2002, is that female executives were definitely looked at as being less relevant to the workplace than male executives. It's still a very, very heavily male-dominated landscape. We're seeing a lot of improvement in that area. But I think one example that kind of drove home to me is we actually had a accounting candidate earlier this week that was talking to us and was sharing some information on partners in Big Four accounting firms. What do you think the distribution of partners in accounting firms is by gender? Do you think it's heavily leaning towards male, or or is it more equitable towards male female? Still very heavily male, very heavily male. It's like a 4-to-1 distribution. So we still have a lot of work to do, I think, in that regard. We're making progress. It used to be that it was like closer to like a 90-to-1 ratio. So we're making progress. We're not quite there yet. And then, as pointed out in the case, the SEC does not require public companies to have their quarterly financial statement audits. What responsibilities do the auditors firms have in regard to quarterly financial statements to your client? Matt, what's your group say on this one?
Their main responsibilities with quarterly financial statements are just to make sure they're not totally, completely off base, but because they are quarterly, they are more concerned with getting them out the door and into the hands of users than they are with making sure they are 100%.
Yeah, that's very, very good. There's a succinct summary. So this is an interesting question. There's not a correct answer to this question, but I'm going to ask it for the remaining two groups. So in your opinion, should quarterly financial statements be audited? Leah, what's your group say?
We actually said no. We think it would be very beneficial. We just don't think the effort that it would take to do it is worth. I don't think we have the capacity to do it if we're already doing year-end financials.
Yeah, so I think that's a relevant point. Maddie, what'd your group say?
We kind of said it depends, but also said the same things as Leah's group, that it'd be really hard to execute and already be like adding more work to an auditor's.
Yeah, I have a bit of a different viewpoint than that. I agree that if we use traditional audit mechanisms, that's what we're saying for quarterly auditing of financial statements is not practical. That's not something we can do consistently. That being said, we have a much different types of technology associated with accounting than we did 20 years ago. And so continuous auditing and continuous monitoring are a lot more practical nowadays than they were, back when I was auditing. So if we think about auditing in a different perspective, it may actually be a lot more feasible. All right, that's it. We've got quiz on Friday and next CPA prep. See you all then.